Hey guys, what is going on? Welcome back to Dr. Dividend. First and foremost, I want to thank all of you guys for the support on the channel. If you like the content, if you like the video series, feel free to like, share, and subscribe. And if you are a subscriber, make sure to hit that bell button to get alerts and updates on all new content posted on the channel. Today, as you can see here, I have a couple of different tax brackets pulled up because today I'd like to talk about long-term capital gains tax rates and the tremendous advantage that can be had at tax time for doing a few simple things when buying and selling a stock. As you can see up on screen, I have the marginal tax rate tax bracket, which essentially is your income tax bracket. You can see 10%, 15%, 25%, all the way up to 39.6% on the bottom, as well as what the corresponding long-term capital gains tax rate is, 0%, all the way down to the bottom there, 20%. So you can see just between the difference of the first and second column, at the very least, there's a 10% difference up on the top here, 10% going to 0%, and a 15% even going to 0. And then on the bottom there, you have essentially 40% going to 20%. So you can save anywhere from 10 to 20% at tax time for simply holding a stock for 1 year between the buy date and the sell date. Pretty simple, but it has very, very huge tax implications, as you can see here on screen. So if we go up to the 10% tax bracket, again, these are all income tax brackets. 10% essentially is roughly less than $10,000 total income for the year. 15% is $10,000 to $38,000 or so. 25% is $38,000 to $92,000. The 28% is $92,000 to $192,000. The 33% tax bracket is essentially, I think, $192,000 to $416,000. And then 39.6 is greater than that. You're looking at $420,000 plus. So you can see on the bottom here, the low wage earner here really doesn't have to pay anything for long-term capital gains tax rates, while the earner who's making quite a bit more money can save quite a bit of money, 20%. If you think about that, if you sell a stock, you buy a stock for $100, sell it for $200, you made $100 of capital gains, you essentially are saving yourself $20, 20%, which is quite remarkable if you kind of think about it, that an average return of anywhere from 7 to 12% is considered a very, very good year rate of return. So you can save yourself 20% just by doing that one simple thing, holding your stock greater than 1 year between the buy date and the sell date. And that's really all that is entitled or entailed to get you the preferred capital gains rates here. So if you're in the 10% tax bracket here, if you buy and sell your stock, if greater than 1 year has elapsed between those two events, you essentially are having to pay at tax time nothing. Same thing corresponds to the 15% tax bracket. If you buy a stock, wait a year, sell it off at over 1 year, at a year or over, you essentially pay 0%. So you can save anywhere from 10% in the first tax bracket here to 15%. And then once you get down in the 25% tax bracket, you're essentially saving yourself 10% here, 18% here, and you can see how this kind of stacks up all the way up to 20% for the 35% tax earners. And essentially, it's about the same for the 39.6% tax earners as well. And again, the only thing you have to do is hold the stock for greater than 1 year. And I've been referring to this on Robinhood because, unfortunately, Robinhood, unlike some of the other brokerage accounts, only has a first in, first out. So if you buy a stock, that's basically the first into your portfolio. Then when you sell a stock, it's the first out. So let's say you had Ford, for example. That's what I have in my portfolio. Let's say you have 1,000 shares of Ford, and you're day and swing trading with only 200 shares of that. Well, you're always going to be resetting the clock because the first stock in is the first stock out. It's not last in, last out, which would be preferable because you can hold a set of stocks for the long-term capital gains tax rates. When you sell off that stock, you would have held that stock for greater than 1 year. So instead of paying these tax rates on this side, you would essentially be shifting it over and paying tax rates on this side. Unfortunately, Robinhood does not do that. It's only a first in, first out tax method. On other brokerage accounts, there are literally 10 to 15 different ways of doing the tax accounting. And also, there's specific tax lots as well. So if you imagine each one of these is a different buy date, you know, right now they're tax rates, but let's say you bought a stock on January, February, March, April. In other brokerage accounts, you can specify exactly what stock you want to sell off. You want to sell off this tax lot here, this tax lot here, this tax slot here. On Robinhood, it's only first in, first out. So on other brokerage accounts, you literally have a number of different things to do with regards to taxes. You can do first in, first out, last in, last out, last in, first out. There's all sorts of things. You can specify the exact tax slot. Robinhood, you cannot do that. So a lot of my videos, I've not been doing any day or swing trading in stocks that have also been holding for the longer term, just because I can never get the stocks over that 1 year of holding period to get those long-term capital gains tax rates. As you guys know, for Portola, I'm looking to sell that off next year. I really can't do any day or swing trading with that stock. I think it's been a great day in swing trading stock, but I can't do it because if I do, I'm resetting that clock, and then when I start to sell off my stock, I'm going to have to pay this extra, 20% or so here. Going from 28% to 15%. That's a tremendous tax advantage there. You're essentially saving yourself a year of investment by doing that. Going from the 25 to 15%, or even up here, if you're in the, again, over $420,000 made, you can save yourself 20% here, which is tremendous. So that's why a lot of stockholders are buy and hold stockholders. They kind of shy away from doing the day and swing trading just because of all the tax exposure that you can accumulate throughout the year. So if you continue to make $100 gains on a stock, at the end of the year, you might have to pay back 20% of that. And if the buy and hold strategy is making 25%, with the long-term capital gains rates on top of that, the preferred ones, you may have much better rates of return by just simply buying the stock, holding it, and then selling it off after that 1 year period has elapsed. So that's why a lot of investors are buy and hold investors, and they really shy away from doing any day or swing trading just because of the tax implications. So I hope that was a pretty easy thing to understand here. Again, the marginal tax rate, the tax bracket is your income tax bracket. The long-term capital gains tax rate is essentially if you hold the stock greater than 1 year between the buy date and the sell date. You can see here 10% savings, 15% savings here as well. 10 all the way up to 20% for the larger tax accumulators at the bottom there. The folks with the higher income taxes can also save quite a bit of money at tax time. So that's the advantage of long-term capital gains tax rates. Essentially boils down to holding a stock greater than 1 year between the buy date and the sell date. Pretty simple, but when you're doing some complex strategies as I do, day and swing trading, dividend capture, so on and so forth, you can't really do that with stocks that you're holding for the longer term, in Robinhood at least. You can do it in E-Trade and Vanguard and some of the other places that allow you to specify the exact tax slot you want to sell off. Robinhood, unfortunately, is just a first in, first out, so please keep that in mind if you are trading on Robinhood. The other brokerage accounts, not that big a deal, but you definitely do want to keep holding your stock for greater than 1 year before selling it off to get those tremendous tax advantages as I've kind of detailed here. So yeah, just again, wanted to go through that. A lot of viewers on the channel wanted an explanation behind why I keep talking about long-term capital gains tax rates and what are some of the tremendous advantages of doing that, and then how you qualify. Very easy to qualify. Simply have to hold the stock for greater than 1 year between the buy and the sell date. So yeah, let me know what you guys are thinking about at tax time. Do you guys take this into consideration when you're doing your day and swing trades, or are you simply a day and swing trader and don't really care about that? I know a lot of the buy and hold investors will say that the reason they do that is because of the long-term capital gains tax rates, as well as the rates for dividends as well, preferred dividends, which I'll do a separate video about as well. But essentially sort of the same type of scenario. There's a few different caveats behind that. It's not a year of holding period, but there definitely is a holding period with that as well. So day and swing trade investors also have to take that in consideration. Not only the long-term capital gains rates, but also the dividend tax rates as well. So yeah, not to make the video too long, just wanted to quickly go over what long-term capital gains rates are all about. So kind of with that, I'll end the video. As always, if you guys enjoy my videos, feel free to like, share, and subscribe.